Welcome everyone to the Kendall Report, where I share my 44 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Folks, you did a pretty good job. Thousands of you watched, only about 675 likes. We're going for 1,000. Click that like button so we can get some good traction. In tonight's video, I'm going to be focusing in on some of the banks that are in question right now. We're going to talk a bit of Fed talk and what I think is coming up, because we do have a meeting coming this month. And then I'm also going to talk some gold and silver and a few other things that I think are important, semiconductors, that type of stuff. Let's get into tonight's video. Okay, folks, so a fair amount to talk about tonight. I'm hoping that we can ultimately get these videos down to about 30 minutes or so. I can talk more than the average guy, so that probably won't happen. There's a fair amount going on. A couple of things. I ran across a thread that kind of triggered me on X the other day, and there's this scenario. It's always what I talk about when I mention zero hedge. I always call that basically a fiction site that is presented as a news site. And very little ever comes true that's on Zero Hedge, but it's great reading. It's entertaining. But I ran across a tweet that I thought it really kind of triggered me, because they're talking about a couple things that happened going back to the pandemic. It's like after everything we went through, people can't seem to get by the pandemic, right? So everything is in the rearview mirror. I've told you folks before, to me, investing is like driving on a dark road with your bright headlights on, and you're looking for the next corner. You're always looking forward. Trying to invest looking in the rearview mirror, really bad strategy. It's good to have that perspective of what happened before, but it doesn't do an awful lot in looking forward. And you can go all day and say this formation's like this one, so that means it's going to happen again. Probably not. History doesn't repeat itself all the time. But what happened was they were talking about a couple things. In the pandemic, we saw the Fed actually get into when they dropped the reserve requirements to zero. And now that's being promoted out in the street that this is going to cause the next banking crisis. Now, the fact that the Fed said that they had to be at zero reserves doesn't mean banks were at zero reserves, okay? They just weren't required. It actually freed up a lot of liquidity, and that was the point of it back in 2020. And I don't think there's anything that's going to go on. So I'm going to go on for a couple minutes about some of these things that I think are being put out into the community, that the investment community, that aren't very good. And most likely the people that are promoting these kind of stories have something to sell, like gold and silver and Bitcoin or whatever. And not that I'm going to cover gold and silver tonight. I think they're valid investments, but a lot of times we see this hype that comes in around this stuff. So the view is that there's no liquidity in the banking system because the Fed doesn't require it. That is not true at all. And in fact, the banking system overall is in pretty good shape. What I'm going to do after that, I'm going to talk about three things before I get into going to charts and going through that review. But we're definitely just looking at the potential of what isn't going to happen. Like I said before, you can make a lot of money fading a lot of these so-called, and I'll do air quotes, so-called analysts, and maybe I'm one of those people. I've been around a long time, seen a lot of different things. Many of you have followed me for the better part of 4 years now. And matter of fact, it's probably 4 years this last month, right back in February of 2020 when I met a lot of you. And the point is that this illiquidity story that's being played out, and that the banks are all going to roll over and there's going to be a big run on the bank and there's nothing to back it up, couldn't be further from the truth. The other thing that you have to look at, and I'm going to try to tie several things together here, is look at the Fed's balance sheet. And I know I've discussed this with a good friend of mine. Somewhere around $3.5 to $4.2 trillion is on the balance sheet just for the purposes to backstop the entire banking system. And, folks talk about the balance sheet of the Fed, being so big, and they think we're going to go back to what it was in 2008 at 900 million before all the great financial crisis and all that. We're not going back there. The economy is multiple times bigger. GDP, everything is growing. The gross product is huge compared to where we were back in the day. It's amazing what's happened in the last 14, 16 years, actually, in the growth of the economy. So where I'm going at with this is there isn't any liquidity crisis. I'm going to go through some of the bank indexes. This was something I touched on last night. I want to talk to you about. Like I said, the channel is pivoting more to this kind of talk. I will not going to go through any of the indices and things like I normally do. The plan is that's done on my Substack account. I put a lot of effort into the Substack, so that's kendallreport.com/newsletter to get there, or you can go to kendallreport.com .substack. So either way, but the point is that what we're seeing is there is no liquidity issues. If you recall a year ago when the regional banks were having issue, it was fixed quite easily because the Fed just set up a discount window facility just for banks to go to. And what they did during that time is try to it used to be like you were a bad bank if you hit the discount window. And they tried to kind of take that mystique away and make it much more friendly and like, hey, that's okay to go there to get money and liquidity. And all of these people out there were trying to hype that up. The banking crisis, it's another 2008. And Bob was over here going, no, it's not. It's not at all what's happening. In fact, there was a few banks that had some capital dislocations, some mismatch of assets. We all know what happened. And that was actually, should have never got to that stage. Won't go there. We're talking about Silicon Bank and how all that started. But the point of all this is there is no lack of liquidity. And I would tell you, and I've been not a fanboy at all necessarily of the Fed, but I do think they've handled this situation much better than I've seen in the past. And during the Grandma Yellen days, we didn't really have any crises at that time. And before that, we had Greenspan, Helicopter Ben, and all of that era, and then kind of came in after all this liquidity was created. And so the Fed has changed quite a bit from what it was 40, 50 years ago. I've been around 44 years. Things have changed. So what's happening right now is this zero reserve isn't really, it's just required by the Fed. There's plenty of reserves in the banking system. You and I running any kind of business would be crazy not to have reserves in the bank in case something doesn't work out. When you're in the banking business, it's treacherous almost everywhere you turn, from asset changes in prices to whatever, to loan losses, whatever things happen in the economy. So it's a very high risk business. That risk is the first thing that every banker looks at, and through hedging and other types of things and trying to match those assets. And those people were pretty amateur, if you'd ask me, but they kind of get sucked in by the Fed. So I'm trying not to get in, falling into this rabbit hole on that stuff. But so what I believe is happening out there with the Fed is that the Fed has the backstop. They have the money in the balance sheet. I think we're getting very close. Now let's move. In 2 weeks from now, we're going to have the Fed meeting. I think it's 14th. I forget the exact date now. I think it's 14, 15, something like that of this month. And I don't think they're going to lower rates at this time, but I think we're getting closer to getting to the point where the selling of the assets off are going to slow down. We're going to see QT even slow down or ultimately come to a halt. I don't think they are going to lower rates this time. It's possible. I think the next meeting after this is in June. It's possible that we come into at that point. I've been talking to you about when I've done my rate analysis, both in the Substack newsletter as well as yesterday on the channel, is that I'm still looking at ultimately this flat yield curve around 4.25%. This higher for longer doesn't mean higher from here. It just means we've basically normalized rates. If you go back and look at long-term yields, you'll see exactly where we are now. It's just you can back the clock back, about 6-8 years ago. This is where we kind of belong in the rate structure. But the Fed isn't really having a big need to do anything. It's appearing by all the metrics that we see, and people are going to come here on the channel and say, hey, Bob, you don't understand. These are all phony metrics and all that. It's what we operate off, and I've been around for a long time and been operating off these numbers, and the market sentiment is going to change based on these numbers, whether you believe them, want to believe them, think they're bogus, all that really doesn't matter from that standpoint. What matters is how ultimately the markets perceive them, and market participants, which is you and me. And so the way that we position in the markets are also very big on that. So I just want to kind of build in. I don't see any banking crisis really going on. When we go to charts, I'm going to go through a couple areas. So let's go to another area that I want to talk about as we're watching these markets unfold. Without a doubt, I'm looking here, once again, Nvidia was, the whole semiconductor was a huge, that was the number one performer in the market. Nvidia up 3.6, TSM up 3.6, all of these, AMD up 134, everything, ASML was up again. So we're even looking at Intel and Qualcomm, and everybody's just kind of participating in this sector. So I will go through some of these stocks tonight. Like I said, I'm really pivoting the channel more to macro and what's going on from day to day, and everybody's really talking about all this stuff like it's way overdone. I've already pitched, I believe last night in the video I talked to you about what I believe is going on with AI and how that's driving a lot of the markets here. So that's part of it. But I think overall, as it goes to this thing I always try to talk to you folks about on the channel, as things aren't as risky as you're being told it is. And even though we're trading all-time new highs, markets were terrible to watch today. It wasn't really about as lackluster as it gets. I'll write about that tonight in the newsletter. But the bottom line is we're at this stage where when you're at all-time highs, it just brings out everybody wants to be the one that picks the high. So when you see these TikTok videos and all these amateur folks out there going, this is the high and the collapse is coming and all that stuff, don't get sucked into that stuff. Pay attention. If you don't have the indicators, you should have them, because they're going to give you good guidance in at least where the extremes are when there's a worry of things. And as I showed you in the last night in the long-term outlook, and if you didn't see that, go watch it. And I went through monthly charts and quarterly charts, and we really did a deep analysis, and nothing is showing up as risky. The database, the thing about doing these videos right now, at this time of day, I don't have the daily results of the database, but I will have them when I write the Substack tonight. The beauty, just a quick, I'm really trying to drive folks to the Substack just because it's very informative, and it's got, it's basically, it's tactile. You can print it if you want, but it's in your hand and in your email box that you can have these numbers right there. But I put all the market grid numbers out every night, and all the database numbers come out when I do that. There's graphical graphics inside of that to get there. So it's $8 a month, okay, and it supports the channel. It does a lot of good things, and I appreciate that. We've got thousands have already signed up. I just keep telling folks there's a whole lot of you that need to have that. So let's talk just one more thing here, and I haven't covered gold or silver for a while. So I am going to bring up charts and go through some analysis like I usually do. And the plan is to go through the banks first. We'll go through the conductors. Then we'll end with gold and silver. Everybody's always asked me to cover silver. I very seldom do it, so we'll go through it. Actually, as I always do on this channel, I glance at these charts, but I will do all my analysis on the fly as always. So let me see what you folks are, I don't know. I'm looking at, Chris is saying S&P will get to 6,000 by the election. I do have targets right now, 6,100 plus, and I think it's pretty interesting what's going on there. Let me look at a couple comments before we move on. Yeah, so everybody hit the like button. I think folks are not used to me coming up. I'm back, so make sure you tell your friends and spread that I'm back online here, and I'm looking forward to really getting things going at a much higher level. Yeah, so Anthony, you're right. Listen, folks, I'm telling you, I'm proud of what I'm doing on the Substack. I really am. Mondays is a little in depth because I talk about all the earnings and all the different reports coming out for the whole week, and I post them in there so that Monday newsletter is a good reference for the entire week for what's going on. There's expectations there, predictions of what each report's from a consensus standpoint is looking at. So it's kind of it's a worksheet that I keep on my desk actually. So you should be doing the same thing. So let's do this. I'm just looking at my notes here, make sure I've got everything. Just to summarize real quick, I'm anxious to see what happens with the Fed, just back to the Fed, and then we're going to move on, do some charts, and we should be able to get out of here. How are we doing? 16 minutes? Who knows? It's possible we could get out of here in 35 or 40 minutes. I would like that. And so I think one of the things that I was trying to emphasize when we're talking about the Fed is they don't have to do much. They have actually engineered, I don't know, I don't like using the typical terms out, soft landing, those type of things. I'm not sure that is a necessary thing to talk about, but I still see people around the channel, around X, I see comments about this coming recession. You'd think these guys would get tired of this. Been talking about it for a couple years, the coming recession, and like I said, I don't really see that. I'm not saying there won't be soft spots, there won't be rotations in sectors, those type of things, but I don't think the Fed has much to do at the moment. I think June is my meeting target that I'm going to look at. So let's go ahead, let's get into some charts and just see. We're going to start with the banks first, and we'll go from there. Okay, I've got 10-year notes up here. Let's go to KRE real quick. I think this is the daily chart. You can see we're just consolidating. What I want to look at here is really the weekly and also the monthly chart. So I want to keep this longer term perspective and kind of a configuration here. So we're seeing this thing. We went up to the 200-week moving average on KRE. If we go back, let's go back to, this is where the big meltdown was supposed to happen. When they were screaming the loudest about the banking crisis, that was the low. And I remember, I think I was on, when we were over here, it was after the collapse, I did the interview with Meet Kevin, and we were talking about this, and I said, there is no banking crisis, and there is no recession coming. And the reason why is just everything I was seeing, and we know hindsight 23 ended up to be an incredible year for the markets, and now I think we're having a back-to-back scenario, which we haven't seen for a while. But this index, we went up to 200, and now what we're seeing is trying to consolidate here. We do have some downward action potentially. It's interesting because in my notes here I have that the the relative is that KRE is the weakest of the indexes. So this is the regional bank. So it looks like there is some additional risk relative, just looking at the charts. We do have some downward Fibonacci targets that would suggest we'd have some potential move back down toward the lows here that we printed, back in October. But I don't think it's at real risk. The algos are suggesting some stability, but definitely downside risk. And most likely we're going to get sandwiched between the 40 and the 10-week moving averages from that standpoint. So as we look at this pattern, it's not too bad. Let's go to the monthly. So let's see how far out we can get here. Now, monthly has a much different picture. The primary is still looking like we're going to rise back up to around maybe $58. We've got some Fibonacci targets up here monthly. The algos are trying to move toward a positive from the standpoint of the PPM 1 and 2. PPM 3 is actually negative. All that's telling us that that is where major resistance is right there. And that number, I'm just trying to pull a number up for you. That number is right at 58. So that's going to be, from this index standpoint, we probably just consolidate here. But this is not the kind of look that we would be expecting to see if we're going to see a major collapse. So let's go to the KBE, which is the bigger banks. Look at that index. Now you'll see this has a bit different configuration, much more positive. We'll stay with the monthly here. And so we came down to the 200-month moving average, and now we're kind of rising in this wedge here. We're probably bound into this range where you see the market grid set up right now. And it looks like some potential where it's going to soften a bit from the PPM 1, but it's really all it's doing is flattening out from the standpoint. It comes out, just that where it's going to be still very positive as we go forward. And PPM 2 is pretty solid, so we're really looking at stability, like a range bound on this index, more so than anything else. The numbers, unless you're trading it, aren't that important. I just want to set up the overall pattern that is setting here from that standpoint. So this is the range that we're likely to stay in here, looking at monthly. This is going to be like each bar here is a month bar, so it's going to take a while to go. So let's go to the community banks, which I thought maybe these were looking a bit worse than the others, but in fact, it's about the same as the big banks. The community banks seem to be fairly solid, and it looks like for the most part, the risk is still in the regional banks, so there is some risk there. I'm not trying to blow off this whole thing, but this whole liquidity crush and bank runs and get your money out of the banks and all that kind of stuff, I don't think that's healthy talk, and I hope these people are smart enough to, I saw something on, I had CNBC on for a few minutes today, and there was a guy talking. You always know when a guy who wants to buy a stock starts talking about what the company does and they're talking up the company. I always know that guy's, he's coming into the stock like some of these semiconductors. That's kind of what triggered me on the semi thing today, is just seeing the talking heads talk about this. And they're talking about, they're buying ASML, they're buying Nvidia up at these, I'm like, at these levels. I'm like, where have you been? You've just now figured this out? This is crazy. So, and then they start justifying and the marketplace and how everything fits together from that standpoint. I just don't see that as a very healthy talk for people to hear in the marketplace. Not that, I try to keep things very reasonable and straightforward, and things that I think you folks can consider and look at what I'm saying. It's okay if you don't agree with me, but at least bringing in some perspective from a quantitative standpoint and those things. As what you're going to see as we come into my new channel that we're going, I'm going to start bringing things into portfolio environment, talk about rotation in portfolios and different types of things that really matter being involved in the markets. I know a lot of you folks are probably just, like to trade indices, and that's fine. But the real thing is there's a difference, I always say, between speculating and managing money, whether it's yours or someone else's. That's a whole another game from that standpoint. So let's, okay, so we got those covered. Let's take a look at some of these stocks, because I think I think this is, let's look at Nvidia. So let's go through some stocks here. Okay. This is a monthly chart. This thing's vertical. For a guy trying to justify, this is what I oftentimes call the Jim Cramer trade: buy high, sell higher. And even the guy on the panel, I kind of like this guy, I forget his name, I think it was Fast Money or something. And he said that you want to buy this thing here. I thought it was pretty funny. I can tell you a couple things. We play these rallies really good with our software, with WaveTech and Portfolio Expert. But if you look at this angle of attack, it's pretty strong. But what normally happens, we saw this type of action even on all stocks that blow off like this. So there is definitely something big. You can see this is a monthly graph now. And you can see from just looking at this that what we're seeing is that the upward momentum is bleeding off. But we can go bleed off momentum for months, and we're still we go from a PPM value of what, I'm just looking at it right now, 9.52, which is a ridiculous number. It's parabolic, basically. And even when it drops down, it's still going to be at a 5-handle plus on a full integer. Anything over 0.25 is a trend. We're talking 9.52. So these are really big numbers when you get into these higher level charts or longer term charts. I'm just going to go to weekly, get a little better perspective, but even weekly is getting to the point where you see the PPMs are starting to roll down. What these are telling you, that you can see the angle of attack. So the WTR, this is the WaveTech algos running off of the PPMs, showing you what this value is being projected to do. Most likely what we're going to set up at some point is what we're going to see at some point is actually a sideways move into this moving average, and at that point we'll be able to evaluate what the algos are doing and doing all that. But for right now, even if you have this in a weekly model in WaveTech or Portfolio Expert, you're probably going to have that in there at a much lower level than where we are here. I think we bought it, the last buy was around here in the 500 handle or in this consolidation, and this is on a weekly pattern, right? So, but you can see that it is starting to roll. You're seeing the momentum burn off, but it's sort of like if you ever use relative strength or stochastics or something, at some stage you get to what I call terminal levels, and then it just corrects internally. The indicator corrects. Doesn't mean the market's necessarily going to do that, especially when you get to extreme values, because if you ever, I won't show you today, but if you look at that probability map that I've shown you on the on WaveTech and what the PPMs mean, this is that parabolic curve, and that actually enters around 3 handles. Otherwise, a 3-point something. We're talking 9. So this is big. This is weekly, and like I said, I'm going to flash back to a monthly here, and we'll spend a lot more time on this. But I want you to understand that we're probably going to ultimately consolidate here. I think we're going to see some really big crazy numbers down the road. I think I'm going to go to daily here. So daily has right now a projection for Nvidia to go to 929. So let's look at a couple more stocks and we'll move on, because otherwise I'm going to end up here. We're right at 30 minutes here. I want to do a few more of these just to give some perspective. So let's take a look at let's look at TSM. They're actually building a factory just down the road from where I'm at in Arizona here. And so these are pretty crazy numbers as well, but we're seeing this is a daily. So let's get out into weekly. You can see we're basically, so those of you that know, let me just come up on screen for just a second here. Yeah, so those of you that know what the whole theory of the PPMs are, it's something I talk about, angle of attack. So if you look at this, the curve, just like an airplane, if you're going to run out of velocity and it's going to flatten off, and that's all this is happening down the road. If we went 6 months down the road and look at these indicators, they might be predicting that a change is going to happen. We get crossovers on those PPMs. It starts to indicate that we're going to get below the values of those moving averages. So that's important to understand. That's really one of the techniques that are used in understanding these things. So we're still getting an upward slope. There's still, so that angle of attack, if you just look at the aviation, if you go and Google angle of attack, you'll see charts where it shows where the angle of attack changes. There's actually, even on the downside, there's a point, it's a different velocity, but it is in the markets too. It's crazy how well this stuff emulates the aviation viewpoint. This was something we did way back in the 1984, 86, when it came up with this theory of angle of attack and the velocity. So velocity of momentum, there's the forces that are driving that stock at any given time, all of those things come into play. All right, so this was TSM. Let's take a look at, I want to look at ASML. So weekly again, it appears we're a little closer to getting, I guess, to the point of where this is going to roll over, not so much roll over as to lose that velocity that I was just talking about. You're seeing this little roll, if you can see my cursor here that I'm going through. We're starting to get a little bit of a roll. You could argue somewhere in here, maybe there's 5 waves up. There's a lot of things that really are necessary to understand here. And like I said, my whole goal here, folks, on this channel, I know I was Bob the daily analyst. I really want to tie together a lot of techniques. And like I said, we're going to get into building portfolios, a lot of things that that are going to be necessary to really do what I say. And I want to help you manage your portfolios and protect your wealth. But this kind of understanding, you can see on the PPM1 here, we're looking at ASML. As you can see, this thing is coming into like a hard right-hand turn potentially, where we start to see crossovers. And all this is telling us when it crosses over the first derivative, what that's telling us is we're going to test the value of the moving average. Now, it can be tested a couple different ways. You could have it tested from the standpoint where it goes sideways in, where it consolidates, and then the moving average is rising, so it moves up underneath it. Or you could have it where it turns around and it gets a hard correction, maybe a rejection off some key number that we're trading around, and you come back to that moving average. And at these values, even though it's losing momentum, you're still going to get, that's a buy the dip opportunity. So once you understand exactly how these things work, they're incredibly powerful from that standpoint. And you have to understand, we developed these in 1984. It's funny, every time I think of the number, I think of the current time we're living in and how so many things emulate 1984. You know what I'm talking about. But the bottom line is that this is, we're coming into, like on ASML, at least some hesitation point consolidation, whether it forms a top or, the old story is always, is it Is it consolidation or is it distribution? So we're going to be able to figure that out, but not at the moment. But certainly, you probably shouldn't be buying this thing around here, right? This is not somebody going, well, I'm just putting a small position on. This is what this guy said today. I was just like really just laughing out loud. I'm just putting a small position on so it leaves room for me to add more. What he's saying is I'm putting this on at the wrong time, so I know I'm going to have to buy more and average this price down, which is a really stupid trade. So don't do those things. But this is, I could go through a whole show of this, but there's plenty more. Let's do just a quick view of AMD. I got to go there. So here's another one, AMD. This is weekly. Got a RTX sell signal last week. This is perfect. Look at the little differences that we just went through. We look at Nvidia. Still got some really large. Still got a major upward slope. Still a lot of leeway for Nvidia to consolidate. Still have potential more upside. We had 929 targets. It's almost like you get to a certain stage. Is it going to 900? Probably. Is it probably going to 1,000? Probably. Not guaranteed, but that's what those charts are telling us. Now we look at, this is a weekly chart on advanced micro. It's highly advanced in this particular pattern. You can see we're much closer to that momentum flattening out and starting to get into consolidation. We already had an RTX sell last week, and even though we're following through this week, we're probably going to see, my guess would be, if you look at the market grid as we come in next week, then what you do is you'll see a down click from there. So yeah, and listen, I'm going to be, basically this is kind of, if you have these indicators, I'm teaching a little bit right now, not really a master class, but I think that this is what's going on. Let's see here. Yeah, I'm just, like I said, I'm going to stick to the pattern for tonight. Tomorrow, I want to see more of the action in the markets. I see folks are asking, why not ES? Yeah, that's, like I said, I put some good depth. I saw somebody that don't like my flowery fun that I'm writing in the front end of the newsletter, but that's why you get the premium. That's all the fluffy kind of, let's have fun talking about the markets on the newsletter, and then once you get to the database, it gets very straightforward in just talking about what events are, where the support levels are, and all that type of stuff. So that's it's basically exactly what I'm doing in what I've been doing in the live streams forever. So all right, so let's move on for a second. Let's do the metals. Let's see where we are. We're 37 minutes in. So let's just see. I have not covered gold for a while. We're actually printing up on a weekly up at the top end of the script from the standpoint of where gold has been. Where it looks like, I always joke about Peter Schiff. I always make my Peter Schiff joke. So Peter Schiff should be fairly happy right now. But really, if you look at gold, we've been in a major locked-in range, 21.52 high here on this back in December. Now we're getting back up at 21.28. We're retesting those levels. And you can see the algos are just, more than likely, we're going to end up pulling back into this moving averages here on a weekly basis. So we're probably going to pull back. You can see a slight upward slope here, probably coming back in toward 2075. If you recall, when I did cover these gold the last time, 2075 was about the top end, and since I haven't covered, we broke through last week and followed through this week. So we're really just seeing this consolidation from the standpoint on a weekly basis. Let's go to monthly, just to kind of keep that longer term viewpoint. This is where it gets kind of interesting, I think. And on a little bit longer, we've got 3 Fibonacci targets coming in on on gold, and those levels are 22.90, 24.69, and 25.79, which will make Mr. Schiff incredibly happy. But this is these are the upward targets. We are seeing the algos starting to turn up on a monthly basis. I'm going to see what kind of data we have here. I'm going to try to go super cycle on this as well while we're doing this. I'm kind of the theme at the beginning of the month I do every time. So we're looking at the potential here. You can see that upward slope. PPMs are in trend mode. We're 0.70 on PPM 1, PPM 2, 0.79, PPM 3 is over here at 0.45. So we have all three levels of trend in place. We have upward Fibonacci targets. What I would suspect, since this is for the month as we come into April, if we can maintain at least, if we look at the over on the right-hand side here, probably fairly small depending on what kind of monitor you're on, what kind of size you're looking at. But somewhere we're probably looking, if we can stay above 2080 as we come into the end of this month. I know we're just started, so we got some work to do here. But if we can maintain above 2080 at the end of the month, we'll probably see market grid turn up on a monthly, and in April will be much more favorable. And we're looking at the algos here. They're suggesting that we're going to see more upward momentum, start to build that angle of attack a little bit. So gold looks pretty good here. We get in this level. So let's see what happens when I go super. Okay, cool. We have enough data. So this is now the quarterly data. So we're looking at very long term. This chart goes from way over on the left-hand side from 1993 all the way to current. So you can see this ebbs and flow. And there's also Fibonacci targets on the quarterly. And let me bring those up so you can see it. That's pretty insane numbers. 2530, 2878, 3093 is the extreme. Typically, we will get to that level. The only thing that I've been cautioning about, especially everybody has these indicators, is you want to see confirmations from the algos. These things can change if we, like I said, we get a close. This is quarterly, so this will close at the end of this month, this the first 3 months, and then we'll get a new projection. We'll see what kind of numbers we get, but from a Fibonacci target zone, we've seen targets up here in the stratosphere before. If I come over here to July of 2014, there were targets over there for 24, 28, and 3100, right? So these are kind of moderated a little bit, but they're still targets. If you look at the previous Fibonacci targets, if you see over here on October was this 09? You can see we had Fib targets over there for 1459, 1750, I'm rounding off, 1940. And you can see that over here in 2011, we actually hit, let me get to the data so I can see this. We actually hit on a spike right to 1923, just coming short of that Fib target. But this was the better part of 2 years ahead of time. So this is a big time long-term view of this stuff. And yeah, so anyway, these are big targets. So I'm just going to back off, and we're going to do kind of a stair step up. Let's go to silver, and let's walk through that, and then let's see here. It's fairly early, so I maybe I'll entertain some requests here. Let me get through this, and then we'll go ahead, and we always hang around an hour. So if you're been here, maybe we'll do a couple things. We'll take a look at some of the things out there. I don't want to be totally redundant, and I see somebody was one of the nice things about doing the Substack. I usually get those done at about 11 o'clock, 12 o'clock midnight Pacific time. So it's late. It's meant for the next opening, and you should, if you're in London, you should be able to get. That'll be pretty good for the London opening, you should have some good stuff going there. So, okay, so silver daily, right now we've moved up pretty decent here. This is, once again, folks, I need to emphasize this, and I'm just going to change the scaling a little bit. Silver's just been in a range, and now we're trading just like with the gold. We're trading at the upper end of the range, and maybe we're going to get a breakout. If you look at the algos, pretty strong. This is daily, so let's go out to weekly and just start to break this down. Weekly, you really see the consolidation for the better part of the last year. You do have some Fibonacci targets above, though, that are worthy of mention. You've got 25. I'm going to round off 25, 26, 30, and 27 on the upside. And all that does, it gets you back to December of last year's high. So it's not, sounds good, looks good, but it's really more of the same consolidation. There's nothing here. I hear people talking all the time about, you know, all these lofty expectations for silver and gold, and maybe they happen. They're not showing up in any long-term analysis. So let's go monthly. You'll see this consolidation even more. I mean, these are kind of ranges that are really good trading markets, but as far as trending, we don't really have a trend. We got that little blast up back in 2020, and we've been consolidating that thing, just staying above this is monthly chart, above the 200, and we do have some upward fib targets, and we do have positive PPMs that are suggesting we're likely to move up, but those upward targets on the upside are 29.90, I'm rounding up to nearest number, 33.33 and 35.50. That's what these dots here are projecting. Good news, like I said, algos on the are still looking pretty positive from that standpoint. But we start really looking at long term. So this is monthly. You can see we're a long ways from even getting back to the 2011 peak, and we're really this is a pretty boring market, but good trading range market that almost looks like you can count on these ranges happening. Let's see if we have enough data for quarterly. Yeah, we do actually. So this is maybe this consolidation, this base building. Maybe we're finally going to see some movement to the upside, and we've got on a quarterly basis 38, 36, 10, 43.25 and 47.67. So now all these are projecting, folks, is a retest of what already has happened in 2011. And depending on how we get there, we could just find ourselves at it. I would just tell you there's more than a 40% probability that typically the first fib target gets hit. If we come back over here to back in 2009, there were three fib targets, 25, 80, 32.50, and 36.60. And you see right here, we've got to move this up here so we can see it. We got right here in this number, we got to the 38 handle, and then we spiked above that all the way to 49, then it came right back in, and it's almost like a Tesla chart. It's just been shrinking, just going sideways and consolidating. At least we've got a little more volatility coming in the last couple of years. This is quarterly, so each bar that you're looking at here, bringing this up, is 3 months. So this is a super cycle type viewpoint of this. So when you see this stuff, you're also looking at, to get to these levels, you're probably looking at the better part of 1, 2, maybe 3 years out. So these are really big cycles to look at on these things. And so that's it. So what about platinum? Give me a symbol, and I will do it. I just want to summarize, and I think it's interesting when I was talking earlier. Let me put this up. What's a good exchange for this stuff? Okay, here's a good one. So we'll do platinum. I got it. This is, once again, the quarterly. And this has got, so these are interesting. When you're looking at scale, when you're looking at this, like I said, this chart, if I go all the way back, goes all the way back to 1983-ish, okay? So we're looking at 4 decades of price action. You see the big rally when we were coming into the '08 crisis, and as soon as that happened, you see we just plummeted down after hitting to that level. But since then, we did what I call the echo bounce. You get this big collapse, then you get the echo bounce, and then you decline back into this consolidation. So like I said, all of these charts, these metals look similar in that we're looking at some potential longer term. Will these things be hit? Who knows? But we are looking at 1583, 1853, and we'll call it 2050. That's where these green dots up here are projecting, and that is pretty much the longer term. If we back off a little bit, we'll see that everything tightens up, and this is always a situation when you start looking at these charts, whether you're going top down, you go to look at this super cycle range, looking at a 3-month bar is maybe it gives you some perspective of what might happen longer term, but these are, this is worse than watching paint dry when you're looking at those charts. And we start to break down and go backwards. We can see the monthly chart is looking like it wants to turn up. We do have lots of resistance at the 200 month, and that's at 1189. I'm just going to back out of this thing. Weekly, it just gets, as you go, it just gets flatter and flatter and more boring. When then you get down into the daily, you can see it's just all noise here and just consolidation. So it's very difficult from a timing standpoint when you look at these kind of pictures and things and try to determine where it's going to break out. Those, like I said, I started at 3-month bars all the way down to a daily, and you can see it gets noisier and less revealing. So it's very difficult to make these kind of decisions from the standpoint of, decisions from the standpoint of making a call on these markets. I mean, flipping a coin's pretty good on this stuff. And what you need to look for on all of these metals and these bigger projections that are coming out of there, it goes to everything that I believe in and what I've talked to for years to everybody about this, is having that, bringing in some kind of common sense or reverse fundamentals. And what I mean by that is you have to ask yourself, what would cause those type of things to happen? And of course, you come up with a scenario that I'm basically debunking at the core level where we sit right now. You would have to have banking crisis, run on banks, maybe everybody piling in. I wish we could talk about some things that were interesting. I still, from time to time, entertain and look at going to Rumble so we could just have a little more open conversations. But I think we don't need to go there from that standpoint. Most people have a view of what those things are. But I'm just telling you that for the most part, these are really, really hard things to piece together. So a lot of times I'll do analysis like this, and that's why I show you this is how I'll step back and just try to see if I can get some kind of composite of what trend is most likely the valid trend. By that I mean, what is the dominant pattern that looks really good. So usually weekly, possibly monthly, are those patterns that are way more dominant, meaning that there's more upward force or downward force, depending on the market, to try to determine how to play that market. So these are really, really hard ideas, and that goes all the way back to why I created my first models, why I took all the PPMs and all the stuff that I've offered out to you folks, is I basically have given you all the components of the models that I have built. And compiling these into some kind of logic that will get you going and in the right direction is hard, but I am actually going to do my best to show you signals that come out of WaveTech. This is a plan. I have this mapped out fairly good right now, but to show you a plan on how to take the WaveTech models, get a buy signal, and then go to the PPMs and the different tools that you have in the WaveTech indicator suite on TradingView. And then you can kind of compile that and say, oh, okay, now here's the steps. So the hard part is WaveTech has about 60 rules and 600 variables. So you and I, from a human being, are going to have a hard time mapping that out. But sometimes we can simplify some of these things and actually get them down pretty solid. And that's why I just want you to have a perspective when I'm talking to you about these type of analyses, that this is what is being looked at and trying to compile into thought process. And some of this just comes, I've got a lot of years of looking at the same metrics. So this is something else, just lesson here, okay? Quick lesson. The best thing you can do is when you find something to work is to find a way to recreate that analysis over and over again. That's why I built the models. We started to see patterns way back in the 80s. The first models that actually came into software was 1990. And so it took literally 6 years of manually doing this stuff to go, okay, I think now we know what the step-by-step is to understand how to start to compile this into a knowledge tree. And so I've been using AI since roughly 1988, 89. And the AI I use is an expert system, which is a hard code. It's a lot like used at robotics. If you went into Tesla plant, for instance, or any kind of automotive, that is, for the most part, expert systems that are running that type of AI. But this is really just trying to reveal the thought process that goes on here. So little side note there. All right, so I will do this real quick. Let's see here. Yeah, I see somebody said, Bob, you called the bottom last year and went long on 316, going on the bottom, never, don't want to figure out. So what I don't do is try to figure out what ATH, yeah, you can't do that. If you do figure it out, would you please call me? Just send me an email and say, hey, I figured it out. So I appreciate that. And so, yeah, listen, but this is why I show you folks this, and this is what really what I want this channel to be about. So I managed to do an hour, as always. It must be like a built-in clock here. So I'll just come back on screen. Listen, I will have all these details in the Substack. If you're not subscribed to the premium content, you can do a 7-day trial. You can get some of this stuff, see if it's valuable to you. I just feel like I put a lot of work. I think I figured out I've done 56 daily newsletters now, and I'm enjoying the writing. Sounds like I would suspect if you are getting it, you go right to the premium content. That's what it's intended for. The rest is just kind of talking about what's going on and what I went through in the beginning of this video tonight. So please hit the like button. If you hung around, got 140, let's get to that 1,000 number. I really, like I said, I really want to see this channel grow. I also really want to tell you folks that I want to hear from you, so commenting also helps, likes help. So tell me what you want. I do read the remarks. I try to get through them all every night. So make sure that you that you do that, and appreciate it. I think I was just looking here, Bo. You might be the last of the Mohicans, man. I think you're the only Smurf that's alive. So I'm just looking through the timeline. I don't see anyone else, but we don't seem to get some of our trolls that we used to have around. But anyway, yeah. So listen, folks. I'm glad I'm back, and it's been fun being back on live again. So we're gonna tell me in tonight's video. Comment, down below. Comment and tell me what you want to hear. Now, one of the things that is important is that you probably comment once we go offline, because then it shows up in the, I think you have to run the video to see the scrolling comments and see what's coming real time. So if you would comment after the video, that would be good. Just saw a comment somebody made. Just look here. Yeah, so that's one of the things I also like about the Substack. If you get the Substack app, you can just click the little button. It will actually read it to you, and it's very, very well done, actually. Sometimes I'll listen to it and go, huh, that's pretty good, if I don't say so myself. So, yeah, that's funny. Even was that Trigger SLA? Was that the bot, that Eli guy? Is that what you're talking about? That's pretty funny. Anyway, all right, folks, listen, thank you so much for hanging out. Hit the like button. If you made it this far, don't forget to go check out the indicators. All this stuff is in the links below. There's going to be a lot of cool stuff I'm doing going forward. So hopefully you're enjoying the new format. It's great to be back. We'll see you tomorrow. I watch that 10-minute rigged every day, man. That is spot on.